So if you've got real money sitting in IRAs, a TSP, or a 401k, a new tax law just quietly gave you a 4-year chance to permanently lower your tax bill. If you ignore it, the IRS will happily take more of your retirement later. So in this video, I want to show you 3 things. First, what this new law actually changed. Second, how this new senior deduction works from 2025 through 2028. And third, the specific moves you can make in that 4-year window to reduce your lifetime taxes and not just this year's tax bill. I'm Tom, a fee-only financial planner. I'm not your CPA, and this isn't personal tax advice, but I live in this world every single day. And my goal here is simple: help you keep more of your money and turn it into a reliable retirement income. So let's start with what actually changed. For years, the message has been the same. Enjoy the lower tax rates now because in 2026, they go back up. That was literally written into the law. The lower tax brackets that came in after 2018 were scheduled to expire after 2025 and snap back to higher levels. This new law flipped that expectation. Instead of those lower brackets going away, they are now the baseline going forward. So we don't get that big automatic tax increase in 2026 that everyone was planning around. On top of that, the standard deduction, which is the amount of income the IRS just ignores at the beginning, gets bigger starting in 2025. So we move from a world where people were saying, I know my taxes go up after 2025, to a world where tax rates stay relatively low and the amount of income shielded by deductions actually increases. And then on top of that, retirees get a temporary bonus. And that's where the real opportunity is. Starting with the 2025 tax year, if you are 65 or older, there's a brand new senior deduction. It's $6,000 per person. So if you're single and over 65, you can get up to an extra $6,000 off of your taxable income. If you're married, both over 65, that could be up to $12,000. This senior deduction stacks on top of the regular standard deduction. It also stacks on top of the usual over 65 add-on that's already in the rules today. In a lot of cases, you can still benefit from it even if you itemize. So it's not something you only get if you don't itemize. There are 2 big catches you need to know of though. First, at higher income levels, this deduction phases out. For married filing jointly, it starts to phase out at $150,000 and is completely phased out at $250,000. So if you're in the very high income retiree category, some or all of it could potentially disappear. Second, it's scheduled to go away after 2028. Right now, under current law, it's a 4-year deal. 2025 through 2028, then it's gone. So for retirees, this is a temporary planning opportunity. For 4 years, the government is saying we're going to ignore extra income for people over 65. But in 2029, it goes away. Let me make this a little more concrete with a simple example. Imagine you're a married couple, both 67, and in 2026, you have about $60,000 coming in from Social Security and a small pension. On top of that, you decide to take $40,000 out of your IRA to cover travel, hobbies, and maybe some potential projects around the house. So in total, that's $100,000 of income for the year. Because of the combination of the standard deduction, $31,500, the existing age 65 add-on, which is $3,200, and this new senior enhanced deduction, $12,000, that means $46,700 of that $100,000 never shows up as income. Almost 50% of it is completely removed from taxes. That's not a bad deal at all. Now, let's fast forward 10 years. If you do nothing, your IRA may have grown significantly just because of the market appreciation, and required minimum distributions kick in and start forcing you to take money out whether you want to or not. Social Security also is turned on, and maybe you've added some investment income on top of that. Now at that point, the special senior deduction is gone if it doesn't get extended. So now those required withdrawals are landing on top of everything else with fewer deductions to protect you. The whole point of this window is to ask, how much income can I choose to recognize between 2025 and 2028 at deliberately low effective tax rates, so I'm not forced to recognize a lot more income later at higher tax rates with fewer deductions. This matters most if you fit a certain profile. So if you're 65 or older, or if you will be soon, you have large pre-tax balances in IRAs, 401ks, TSP plans, and you expect to draw on those accounts over the next 20 or 30 years, this is directly aimed at you. That's a lot of federal employees, small business owners, and anyone who's saved diligently over the years. So how do you actually use this law instead of just understanding it? The first lever is Roth conversions. Each year from 2025 through 2028, you can look at your expected income, your deductions, and see where you land in the tax brackets. Let's say after all your normal income and deductions, you're in the middle of a certain tax bracket. Well, you can choose to convert some of your IRA dollars to a Roth IRA to fill up that bracket on purpose, using the extra deduction and the lower rates. Now, when you do this, you're choosing to pay the tax now at a known discounted rate, so that future withdrawal from the Roth are tax-free. The second lever is realizing capital gains in your taxable accounts. If you have a brokerage account with stocks, ETFs, mutual funds, and they've significantly grown over time, you can use these bigger deductions and the lower brackets to sell some of those positions, realize the gains, and reset your cost basis, all while staying in a very favorable tax territory. Now, in some situations, you can completely offset the gains and pay little or no extra tax to clean up your portfolio. The third lever is just smoothing out the IRA withdrawals before RMDs start to kick in. A lot of people take as little as possible from their IRAs in their 60s because they want to avoid taxes. And then they get surprised at 73 when the required distributions start to kick in. The balances are much higher, and suddenly they're pushed into higher brackets and even higher Medicare premiums from having too much larger withdrawals. The better way, in many cases, is to say from 2025 to 2028, while I have this extra enhanced senior deduction and the brackets are locked in low, how much can I safely and comfortably pull out each year? You're not trying to zero out the IRA, you're just shaving it down on purpose during years when taxes are on sale. Think of it like this. You can either pay taxes while there's a sale going on, or you can wait until the sale ends and the sticker price goes back up. The dollars are going to be taxed at some point, no matter what, right? The law simply gave you a 4-year window where you have more control at a lower discount, meaning a lower tax rate. Let me walk you through a real example with actual numbers so you can see how taxes change depending on when you pull from which retirement accounts. So here we have John and Susan Sample. They both are 65, retired, and in scenario 1, they're going to pull $30,000 from their IRA or TSP to help cover expenses until Social Security kicks in. They also have $2,500 in qualified dividends, and John has a pension of $33,000 a year. So between the pension, the dividends, and that IRA withdrawal, their total income for the year is $65,500. Now, let's look at the deductions. Because they're married, filing jointly, and both over 65, their standard deduction is $34,700, plus the $12,000 enhanced senior deduction, for a total of $46,700. So we subtract that off, and they're left with $18,800 of taxable income. That puts them in the 10% marginal bracket, owing only about a little over $1,600 in taxes. And honestly, depending on how you set withholding on the pension or on those IRA withdrawals, that could be close to even zero or even trigger a refund if you withhold too much. It seriously all just depends on how you set it up. Now let's change the timeline. Instead of withdrawing at 65, let's say John and Susan waited to touch their IRA or TSP until after they're both claiming Social Security at full retirement age. So in this scenario, they're both 73, it's the year 2033, and required minimum distributions have kicked in. And we're still using today's current tax rules just for comparison. Now they're forced to take money out of their IRAs or TSP. Between the two of them, they have a $50,000 distribution, plus $36,300 from the pension, plus about $50,000 of combined Social Security income. And look at what happens here. Because their income is higher, a big portion of their Social Security becomes taxable. That's something a lot of people don't realize. The more income you have in retirement, the more of your Social Security ends up becoming taxed. Their total income is now $132,000. They still get the standard deduction, which will be larger due to inflation, but the enhanced senior deduction is gone unless Congress decides to extend it. After that deduction, their taxable income is over $91,000, and they owe around $10,000 in taxes. And I've seen this get a lot worse for people in real life. If the market does well for, let's say, 5-7 years, those IRAs get bigger, which means your RMDs get bigger. Bigger RMDs equal more taxes unless you draw significantly and strategically earlier when your income is lower and deductions are better. Now, for some people, this doesn't bother them. They say, if I owe $10,000 or $30,000 in taxes, who cares? My money grew and that's a good thing. And I get it, that's totally fair, but many people I talk to would rather have more control and put some of that money toward their kids or their grandkids instead of handing more over to the IRS. So under the current rules, here's the timeline you're working with. The key tax years are 2025 through 2028. During those years, if you're 65 or older, this new senior deduction is in play, and the lower tax brackets are locked in. Starting in 2029, that extra senior deduction goes away unless new legislation extends it or replaces it. If you do nothing between now and then, your IRAs, TSPs, any 401ks that you have will most likely grow. Your required withdrawals down the road may get significantly larger. The extra deduction disappears, and you've just allowed for the best planning years of your retirement to drift by. So what should you actually do with this? Practically, you want to map out a simple 4-year tax plan. That starts with estimating your expected income for each year from 2025 through 2028, Social Security, pensions, part-time work, rental income, all of it. Then you layer in your deductions, including the standard deduction, the existing over age 65 add-on, and the enhanced senior deduction once you qualify. And that gives you a picture of how much of your income is protected and where you fall within the brackets. Now from there, you decide how much pre-tax money you want to convert to Roth or withdraw outright each year to fill up the brackets you're comfortable with. You also decide how much in capital gains you want to realize while those deductions are in play. And you coordinate that with when you start Social Security and when your RMDs begin, so you're not accidentally stacking income on top of income in the same year. You'll also want to stress test this. What if the new law changes again? What if markets do better or worse than you expected? Does this still look like it reduces your lifetime tax bill in most reasonable scenarios? Good planning software and a qualified professional can help you do that math. Now, I know this sounds like a lot. The point is not that you need to become a tax expert. The point is that you have a 4-year window where for many retirees, taxes are on sale. You can either use that window to move money on purpose from being taxed higher later to taxed lower now, or you can let it pass and hope the future looks the same or better. Now, if you're looking at this and thinking, I don't want to guess with my life savings, I want a clear plan for my situation, that's exactly what we do with clients. There's a link below the video where you can learn more about how we help retirees build tax-efficient income plans, and if it's a fit, schedule a time to talk. If you want to see where this really starts to snowball though, you'll want to look at what happens once the government forces you to pull money out every year. That's where the big tax bills start to show up. So in this video, I'll show you exactly how RMDs can hit someone with a larger IRA, TSP, or 401k, including how to estimate your own future tax bill and ways to reduce it before those withdrawals become mandatory. Click here to watch, and I'll see you over there.